Hi, I'm Rick Albert, and welcome to The Key to the City of Angels, the podcast where we unlock the secrets of Los Angeles real estate. With over 300 real estate deals under my belt, I've seen it all, from house hacking strategies that build wealth to helping clients close multi-million-dollar deals in one of the most competitive markets in the world. Every week, I'll bring you expert insights, market trends, and inspiring success stories to help you navigate the LA real estate scene. Whether you're a first-time buyer, an investor, or just curious about what it takes to thrive in the City of Angels, this podcast is your guide to making smarter decisions and achieving your goals. So grab your keys. It's time to unlock your path to prosperity in Los Angeles real estate. Hello, everyone. Rick Albert here, the host of The Key to the City of Angels. I am super excited because today I have Kevin Jerry of KAJMST, basically tax strategy. Taxes are kind of like the legal system. There's like a whole overview, but then you have specialties within it. So, Kevin, first of all, thank you for being on. And why don't you tell us how you kind of got into this space?
No. First of all, thanks for having me, Rick. This is a pleasure. I got into this space totally by mistake. I was it's so funny. In another lifetime, I was a printing press salesman. I mean, think about that. Printing's gone, and I was out there selling multi-million-dollar printing presses for Hewlett Packard for a long time. And then it went away. In the Great Recession, nobody wanted to do printing anymore. Everything was digital. So I had to kind of take a hard look in the mirror and say, okay, what do you do? What do you do now? And a buddy of mine from Denver said, hey, have you ever heard of this thing called cost segregation? This was back in 2010. And I was like, no, I've never heard of it. And he said, you should look into it. So I looked into it and loved it. Didn't trust my friend, wouldn't go into business with him for any amount of money. But then I realized, this is kind of cool. This is a way to reduce taxes. And I love helping people reduce taxes. And so I got into it, realized I didn't know anything about taxes. So I went back to school. I got my master's degree in real estate taxation. And then I just kind of made a second career out of it. But I'm having a ball now.
Well, yeah, I mean, it's one of the things I loved about real estate, and part of the reason why I got into it is you exercise both sides of the mind, like the analytical and the creative side.
Mhm.
And it kind of seems like this is in that wheelhouse. So why don't we jump into the cost segregation?
Sure.
Because I don't want to say it's a buzzword lately, but I've been hearing it come up more and more.
Mhm.
My hunch, totally could be wrong. For those who know me, I'm a smartass, not a know-it-all. Is over the last 15 years since the Great Recession, people have been able to amass somewhat of a portfolio because they've been able to ride the interest rate wave, the appreciation wave. And so now people are like, okay, well, now I'm getting taxed through the nose. So what exactly is a cost segregation? Why would someone do it?
Yeah, and then that's a great question. So to kind of take a step back,
Sure.
all assets that are put in place, for a business are depreciated. You have to depreciate it. It's the law. But like I'm looking in your background, like your office furniture is depreciated over 7 years. Your computer's depreciated over 5 years. It's great. Maybe you have a big expensive Mercedes, that's depreciated over 5 years because it's business related. Great. So you take the purchase price and divide it by whatever class life that asset is set up for by the IRS. Office furniture is 7, computers are 5, cars are 5, buildings are 39. And if somebody lives there in like a residential rental, it's 27 and a half. Don't ask me how they came up with 27 and a half. Don't.
Damn it, that was gonna be my next question.
After a while, you just stop asking about the IRS because none of it makes sense. And so all you have to do is just take what they give you and run with it. But you try to figure out where they got it, you'll end up in a mental institution. Anyway, let's say you've got a residential rental property, just a single family somewhere in, I don't know, the valley, and it's worth $1 million. So what CPAs will do, and it's not wrong, is they'll take that $1 million and they'll divide it by 27 and a half. It's called straight line depreciation. And that number, that mathematical number is now used to reduce your income. And it reduces your income. And as your income is reduced, your taxes are reduced. But that's not that's not that great. If you could depreciate a building over 5 years or 10 years, now you've got a big depreciation expense. Now you're going to really drop your income a lot. But over 27 and a half or 39 years, it's negligible. So what happened was back in 1999, there was a massive court case, and it was with the Hospital Corporation of America. They owe the IRS $1 billion with a B, and they said, well, why are we depreciating our hospitals over 39 years when there's parts and pieces of it, like the X-ray room, like bathrooms, like kitchens, like flooring, like security system, where if we put those in after we bought the building, our CPA would depreciate those over 5 years. So why are they under this umbrella? I'm sorry, I'm from Jersey, so I talk with my hands a lot. But
That's fine.
why are we depreciating in bathrooms and kitchens and X-ray rooms and MRI rooms over 39 when the IRS says you could depreciate those over 5? And so what you would have is the value of all of those components of that hospital when they're totaled up, would be depreciated. You take the total and divide it by 5 instead of 39. Now you've got a lot more depreciation to play with now. Down the road, less, but who cares about that? But right now you have a big depreciation expense. And so that's what we're going to do, Mr. IRS. This is what Hospital Corporation said. We're going to depreciate each component separately and add them all up. And then we don't owe you guys anything, zero. And the IRS said, yeah, well, let's just see about that. So they went to court. IRS lost. And so what the IRS said was, it's called an AOD, an action on decision. So there was a decision that was made for the taxpayer against the IRS. And the IRS now has to state, are you going to fight this every single time this comes up? Are you going to fight it and go to court and probably lose, or are you going to allow it? And the IRS said, we will allow it. But it's got to be done by an engineer, because we don't trust you, Mr. Taxpayer, because you're going to skew the numbers. And we don't trust
Which some would.
Yeah, well, I would. And
Right.
and the CPA probably would. And the CPA, they're like, we don't trust CPAs either, because they're accountants. They have no business even being in the construction valuation business. So that's where cost segregation was born. And it's been allowed for the last 26 years. It's nothing new. Only recently have there been laws like the Tax Cut and Job Act that Trump enacted in 17 that allow cost segregation to actually get a higher benefit, because without boring you, now we can take all that 5-year depreciation and we can take 60-70% of it and just drop it into the current year and wipe out a lot of taxes. So that's how cost segregation got started. It's a phenomenal way to reduce your income now, by increasing your depreciation, reducing your income, reducing your taxes. And then, when you sell your building, there's all kinds of ways to, eliminate actually paying that back, because depreciation is great. The IRS loves it so much, they give it to you and then they take it back, when you sell your building.
Right.
But that's how it got started. So it's a phenomenal way. There's zero chance of audit. It is 100% efficient. It's quick. It's easy on the client, and it drastically reduces taxes so that your clients can take the money that would be earmarked for the IRS and then buy another property with it, or pay debt with it, or I've had clients buy a boat with it, and which is not advisable, but it's
Right.
money. They can do whatever they want with it.
Yeah.
It's phenomenal, and it's basically, if you do it right, it's risk-free.
It makes sense because like even on a practical basis, maybe they got the 27 and a half years, maybe because they know like roofs typically last 30 years, but we know like HVAC is typically about 10 to 15 years depending on usage. Hot water heaters are 7 to 12. So you're right. It's like even if someone wanted to pose an argument like no, everything should be expanded. It's like I'm replacing the hot water heater 3 times during that process. So why would I not shorten that lifespan? Now, is this something because one of like the big questions I get asked is for cost segregation, okay, Rick, I own one property, right? Single family versus I have a portfolio, sometimes between multiple states. Is there a difference in when to do it?
You do it when you don't want to pay the IRS, Rick. That's when you do it. And that's my
Okay.
simplest explanation. There's no right time to do it or wrong time.
Sure.
But some people say, oh, you do it when you first buy the building. But what if you have no in, what if your building's not rented? And you first buy the building, there's nobody in, and it takes you 6 to 8 months to rent it. You're not making any money. So if we create a massive depreciation expense, we're going to take your income down to zero, and
Mhm.
and then what? Then the following years you can use it, but it doesn't make a lot of sense to create more depreciation when you're not paying taxes on that building anyway. Now, once it's
Got it.
rented, and once you get a tax bill, or your CPA says, okay, you owe us 50 grand, and you don't want to pay 50 grand, that's the time to do it.
Got it. Okay, that makes sense. Because again, the CPA is not necessarily going to know because they're general taxes. Um, so okay, so you own, let's say, so it's basically when the property, when you have income, right? Because that's the whole point is you don't want to get taxed on the income. So this is how you would do it. Now, one question I've also been asked when it comes to cost segregation is like, well, there's a cost to doing this cost segregation versus the actual tax savings.
Mhm.
Out of curiosity, and it may be an answer that it'd be hard to answer, have you actually noticed like a percentage? Like, okay, it cost, $1,000 to do the cost segregation, but on average, my clients 2x that, 3x that, that sort of deal.
Yeah, and that's a wonderful question, and I do get asked that all the time. And
Sure.
what we strive for is 10x. Is
Interesting. Okay.
and that's not really that hard, Rick. I'm not striving that hard. But it's sometimes it's 15x, sometimes it's 20,
Interesting.
sometimes it's 50. Because the cost of doing a study isn't linear. So you're building, a $1 million building. It costs us about the same to do a study as a $10 million building. So
Sure.
our costs start to flatten out. And that's where some of these 15, 20, 25x return on investments happen. We did two buildings, one in Sepulveda, one in Pasadena in January. And I think we saved the guy. I don't want to exaggerate. I think we saved him like $2.5 million, and he paid us 15. So
Yeah. So, yeah. Okay. We're good.
yes,
They're
he wasn't
happy.
he wasn't complaining, about our fees. So it can be phenomenal. Minimum 10x.
Got it. Out of curiosity, do the tariffs play a role? Because you can make an argument that cost of construction goes up.
Yeah, yeah, and trust me, I'm not a big fan of tariffs. I think they're silly, and
Only the consumer hurts.
exactly, because it's not.
Only.
Yeah, oh, the country who's exporting is going to get hurt. No, they're not. They're
No.
just going to add those tariffs on, and the importer is going to have to pay him, and he's going to pass those on. I think they're silly. I think they're political, and
Sure.
I just kind of throw my hands up. But this is not a political podcast. Thank God.
No, the next one.
But yeah, they actually will. So if aluminum is taxed and steel is now taxed, those costs are going to go up, and they're going to be passed right on to the consumer. The only person who's going to eat that is the consumer. And
Right.
yeah, now your costs to build a building or renovate a building are going to skyrocket 25-30%. This will play a massive role in helping to reduce helping to offset that by reducing taxes.
Which means it's almost like a vicious loop if you're the government. You're like, I'm going to impose tariffs, but now people are going to do more cost segregation, which means the IRS is going to get less money. It's like everyone gets hurt.
It does, and I don't understand it. It's silly, but nonetheless, that's what we have to work with. So
Right.
let's we can't affect the wind, but we can adjust our sails. So let's adjust our sails so we can take advantage of any opportunity like that. Mhm.
That's what I tell everybody. When everyone talks political talk, I always say, it's like, look, they're like, what do you think, Rick? I'm like, I think I'm going to focus on what I have control over.
Yeah, yeah.
Right. It's like, whether I like it or not, okay, am I going to spend a lot of time on it emotionally? I think about it intellectually, but it kind of ends there.
Mhm.
Right. And like, that doesn't stop me from closing deals. I mean, I have a property in escrow right now, a rental investment property out of state. I'm like, no one stopped me from buying that property.
Mhm.
Right. I'm just going to keep moving.
Mhm.
So, but from a
Yeah,
tax perspective, it changes things.
it does. And from and just taking a step back, I don't care who the administration is, our lives don't change that
I
much.
know. It's so true.
If at all. It depends where you get your news from, and you can get outraged and all that, or you can just say, you know what, life goes on, and
Yeah.
it really doesn't affect me that much. So yeah, your rental property, wherever that is out of state, once you have income on that property and you don't want to pay taxes on it, reach out.
Yeah. Well, there you go. Because it does need work.
Okay, good. Mhm.
So let's talk a little bit about that.
Okay.
So someone buys a property that needs some love, which it was in the news a few months ago that was going to be one of the big things for real estate investing come 2025 is that these homes are only getting older,
Mhm.
right? So if someone does buy a property and there is work to be done, what strategies should investors be thinking about?
Yeah, and that's really where we love to focus on is
Hmm.
stuff like that. So there was a regulation that was passed. It's a massive regulation. It was passed and made mandatory on January 1st, 2014. They're called
Hmm.
the Tangible Property Regulations. And I wouldn't believe a word I said. If I was an investor on this podcast, it's like, this guy talks a good game, but I'm going to trust but verify. So Google tangible property regulations irs.gov. And what it is, these regulations determine when you have a property that needs love and you put in 50, 100 grand to get the bathrooms up and flooring up. I bought an investment house in Colorado, and I'm just thinking of everything we did. We had to take walls out. We had to take the nasty appliances from the 60s and get rid of them. And the flooring, the carpeting. I hate carpeting to begin with, but it was nasty. So we had to do all that. So, and that's just normal, for an investment property. So these regulations that were passed, what they determine is, okay, you put money into this building. How do you memorialize that? Can you just expense it? You spend 50 grand. Can you just take that 50 grand off your income as an expense? Or do you have to depreciate that over 27 and a half years? And
Hmm.
so these regulations basically gave taxpayers a phenomenal opportunity when they do repairs or improvements or whatever, or renovations, to be able to take advantage of tax opportunities. Trust me, that their CPA is not going to know about. And they don't know about it because it's not taught in undergrad accounting. It's not taught in grad accounting. It was not taught in grad taxation at all. It never came up. And yet it's this
Hmm.
massive regulation. So I'll just kind of summarize what it is. So let's say you have to spend 100 grand on that property that needs love. And so what the IRS says, if you bought it and within 2 years, you start putting love into it and you start putting money into it, you have to depreciate those expenditures.
Hmm.
Because the IRS in their view, and it's probably true, you got a reduced purchase price. Your purchase price was reduced because all that stuff needed to be done. And so you've got a deal on that. So they say, for the first 2 years, you have to depreciate everything, which it's under code section 263 capital A. So 263 capital A says, if you buy something and you put money into it, you have to depreciate it. But what's amazing is that you can expense the garbage that you threw out. So when I purchased this rental property in Colorado, the carpeting I got rid of, the kitchens, the bathrooms, they were outdated. But from a tax standpoint, because depreciation starts over, when you actually buy the property, it starts over. And as far as the taxes are concerned, every single component in that property is brand new. It's brand new because depreciating starting over again. We can say,
Right.
I had rats eating the carpet and my appliances were green, from the 60s. I couldn't give these away on eBay. Doesn't matter. From a tax standpoint, they're brand new. So what you can do is, yes, you have to depreciate the new, that, let's say we'll call it 100 grand. That 100 grand coming in, you have to depreciate that. There's no way around it. But you can expense the carpeting, you can expense the bathrooms, you can expense the kitchens, you can expense the wall coverings, all the old crap that went into a dumpster can be expensed. So it ends up, the tax savings offsets a lot of the expenditure going into that house, because you're taking a one-time expense of all that garbage as if it was new. And the guys with sledgehammers and jackhammers and all that, that's the called removal cost. That's removing all the old crap. You can expense that, because if you think about it, when you have an asset and you get rid of a portion of that asset, let's say you have a car and it's used for business and you just get rid of the tires. Well, that car doesn't have tires anymore. So the asset has less value than it did before you threw the tires out. It's the same thing with buildings, that step one is to get rid of all the crap. Now that asset doesn't have a kitchen, it doesn't have a bathroom, it doesn't have flooring. It's worth less than it was with it, even though with it, who's to say, it may have been garbage, but it doesn't matter. From a tax standpoint, it's black or it's white. And when you get rid of all that stuff, now your asset has much less value. And then you put the new stuff in and you get the value back. But if you don't, if it's called a partial asset disposition or PAD, if you don't do the PAD, you are continuing to depreciate the old kitchen, the old bathroom, the old carpeting, and it's in a landfill somewhere. And we were talking about depreciation, how much the IRS loves it by giving it to you and then taking it away. When you sell that property, you're going to have to pay that depreciation back. Well, but you're going to have to pay two depreciations back. You're going to have to pay the new bathroom and the old bathroom sitting in a landfill somewhere. Why would I do that? And so the IRS says, don't expense stuff. And so they give that opportunity for you, but somebody's got to put a value on the crap that was thrown away from a tax standpoint. And and that's kind of what we do. And so we're kind of unique, but this is not rocket science. And but it's got to be done in the year those components were thrown away. So if your investors miss it, they can't go back and get it. It has to be done the year you rented a dumpster. So, and that's just a little bit of the tangible property regulations, Rick, and some of the opportunities that are within these regulations that are being ignored.
Now, as far as the government's concerned, when you do these renovations, they don't care what the renovations are necessarily. Like, for example, you said you moved a wall. Maybe you moved a wall just to make it more functional, but it doesn't necessarily add value versus, hey, I had to replace the roof or I had to replace a kitchen sink. Does the IRS care what renovations you do or no, because they just see the line item?
They don't care what renovations you do.
Got it.
Yeah, they couldn't care less.
Right.
Yeah.
Got it. Which makes sense because I'm just thinking like when I've done my tax returns, it's just like there's just lines.
Yeah, it is just it's
Yeah.
lines and numbers, and
Mhm.
that's all the IRS is looking at. And to be honest, I have been involved in a couple of tax court cases where the agents never even heard of these regulations.
Sure. I mean,
It,
it's hard to keep up.
it is hard to keep up. I mean, every day a new regulation comes out. There's 70,000 pages of tax code. We're talking about this little bit, but
How much have you read?
I haven't read any of it.
You're like, well, ChatGPT said.
I'm not reading. That puts me right to sleep. I read what I have to in my
Sure,
business.
of course.
My business, and I keep up with real estate taxation every day, but entertainment taxation over my head,
Oh.
aviation taxation, construction. I haven't the faintest idea. I just know real estate, which is 10 pages out of 70,000.
Which is how it should be, right? Like we've created such specialty upon specialty, and especially with real estate, there's so many tax benefits. And why is it that real estate has been blessed, so to speak, with so many tax benefits versus other industries? Do
If
we
you,
know?
yeah,
I don't want to question it. I'm just kind of curious.
if I had to guess,
Sure.
I would say because Congress is everybody in Congress owns real estate. When they get into politics, they have a net worth of 100 grand. They stay in politics for 15 years. Now their net worth is 100 million.
I
But
know.
that on a government, a government,
Right.
well, you invest in real estate and they
Sure.
all own real estate. And that may be a little jaded, but
Eh.
that's my guess.
You're probably not wrong. Between that and speaker fees, I think they're probably doing okay. And interesting, like that is what I've heard on the news. That is something that they're looking into. They're like,
Oh,
why are
really?
these politicians making? Why is their net worth so much higher when they've been in public office making 100,000 a year for the last
Yeah,
30 years?
yeah.
There's a disconnect there.
Interesting. I
Yeah.
never thought of that.
Yeah, that's part of the Department of Government Efficiency's tasks is
Uh,
that's what they said. So it'll be interesting to see what they come up with.
yeah.
But back to our kind of
Mhm.
reality, since we don't have those capabilities, we don't have that network yet.
Nobody's paying us. We have to pay people to speak, and
I
they
know.
pay us.
Yeah, ridiculous. Ridiculous. Um, so we've talked about some of that stuff. What are some other things? Because one of the concerns, especially on the CPA side, so CPAs and like loan officers tend to butt heads because the CPA wants you to show that you make the least amount possible. Lenders want you to show that you make the most amount possible. So where do you fit in this kind of battle when people want to continue to buy properties?
Yeah, loan officers. 10 years ago, I was butting heads with them constantly,
Right.
constantly. It's because you're right. They want to see numbers in a certain way. A CP, and then there's two ways to keep your books. There's book and there's tax. Book is, you use generally accepted accounting principles, and I love the word generally. But tax is very specific. You have to get tax right. You know, generally, gap is kind of get it right. But yeah, but now loan officers are starting to understand accelerated depreciation and cost
Mhm.
segregation, but they still don't apply any depreciation to determine whether you get a loan or I get a loan or what our rate is or whatever. So depreciation is kind of thrown out the window. They look at income, they look at your income, what's the income from the property, and all they really care about is do you have the wherewithal to pay this back,
Right.
if things go south. But 10 years ago, I was on the phone with loan officers almost every day. Now it's become mainstream enough where they understand it. but still don't incorporate it in their loan decisions.
Got it. So they're starting to become more practical in that respect.
Exactly. And as far as these repair regulations, the tangible property regulations, they still are absolutely clueless on that. And but these are so much in your listeners' favor. Uh,
Hmm.
but even CPAs, 90 to 95% of them choose to ignore these because they're too complicated. They don't understand. But between you and I, Rick, and it's not a CPA's job to save your listeners' taxes. That's not their job. Their job is to do the taxes, do the financials, do them right, keep them out of trouble, and then next year do the same thing. They're nowhere in in the typical agreements between an owner and investor and a CPA. Does a CPA says, okay, it's my job to to help you reduce your taxes. That's not what they do. So
Yeah. They're
well,
not tax strategists.
right, exactly. So I get asked, well, how do I, what do how do I figure out how to reduce my taxes? Who do I go to? And I say, well, first of all, look in a mirror, learn the basics of the tax code. You don't have to go nuts, but learn the basics, learn when to raise your hand, learn when to say, hey, this doesn't seem right. Hey, I heard this. Is this right? You have to know enough to question
Hmm.
or CPA and steer them in a direction of tax savings because it's not their job otherwise.
Yeah. So basically, every year when they meet with their CPA, depending on their portfolio, they should also meet and just do a consultation with the tax strategist as
Yes.
well.
Uh-huh.
What's the order of operation in something like that? Is it let's do the draft return, then talk to the strategist, and then go back to the CPA? Like, how does that, how would that look?
Yeah. So from an order of operations, I mean, you've got to get in front of this. So you've got to be talking to a tax strategist. I'd say maybe in June, and then again in November. Get your tax strategies together. Figure out what you
Mm,
can expense. Figure out what you have to depreciate. Take the steps ahead of time, because once January 1st rolls around, what you did in the previous year
mm,
is in stone. So meet with the tax strategist while you can manipulate the clay and move it here and do this and do that. And well, I'm going to have long-term capital gains because I'm selling a property. Well, I'm also putting in, I bought a $2 million warehouse and I'm going to put $100,000 into it. How does that play into it? Can we expense some of it? Do we depreciate it? So it's you got to get in front of it from a tax strategist. And then once you have the very basics of, okay, this is what we did, this is how we handled this is how my invoices were set up, then you give it to the CPA and say, this is what I've done,
mm.
use it. So, but you've got to plan for it first, because otherwise, once you wait till January 1st, it's just too late. Now you're looking in the rearview mirror, and you're driving by looking in the rearview mirror instead of looking out your windshield and making small decisions or big decisions moving forward. Instead, now you're looking in a rear view, and you can't do a damn thing about that.
That's like selling a property and then deciding to do a 1031 exchange. And
That's
by
right.
then the pro and by then the property's already sold. Like, no, dude, you're too late.
It's too late. And it's funny you say that, because that happens more often than you may think.
I believe it.
Well, I sold my
Well,
property, Kevin. How do I do a 1031? It's like, oh my gosh.
I met a client. We ended up selling. We actually did a reverse 1031 exchange.
Oh, interesting.
I've done two of those now with clients where you buy the property first, then you sell.
Oh, okay.
It's the opposite. It's complicated, but what I tell people is like it's complicated for the exchange accommodator, and
Yeah.
that's their problem to figure out. But I remember with one of them that I did, they didn't know the process for the 1031 exchange. I'm like, well, yeah, you have to work with an accommodator. Wait,
Uh-huh.
a what? I'm like, you came to the right person. I'm gonna help you out with this.
So when you do a reverse 1031, and I'm not really too
Yeah,
familiar with that, how long do you have before, once you buy the new property, how long do you have to sell the old one? Is there a time frame in
6
there?
months. It's
6
the same, it's the same 180 days. It's
Yeah.
just in reverse. So for a lot of clients, that makes sense
Mhm.
because it's the whole chicken and the egg. What do I do first?
Mhm.
Um, it's really, I mean, it's more expensive, right? A 1031 exchange might be what, like 1,200 bucks.
Yeah.
Reverse might be like 7 grand, which in certain markets, that's a lot of money, right? Percentage wise. In Los Angeles, you're like, I'll spend 7 grand if it means I don't have to worry about the stress. Or like, hey, I need to renovate the house, but I need to move my tenants there or do
Mhm.
whatever. Gives them a little bit more flexibility. But yeah, I've had a few of my clients start doing that.
I, I
Um,
I love that. I
yeah,
mean, that's a phenomenal strategy. Uh,
yeah,
I mean, the downside with 1031s is you always have that clock's ticking. I'm
yep.
gonna sell my property. Oh gosh, I got 180 days now, 179 days, 178 days, and you
We
get
have 45 days to identify.
yeah, exactly. Then you get down to 10 days and you'll buy anything,
Yeah,
anything, and it ends up being a money pit.
yeah,
But your way, I love that. I think
yeah.
that's brilliant.
It's funny. I have a investor client here where I helped him buy a bunch of rentals, and now he's slowly moving the money
Mhm.
out of state. And I was like, "Hey, have you thought about doing a reverse 1031 exchange?" She's like, "No, I like the pressure." I'm like, "Well, that makes one of us."
Get to the airport like a minute before his flight too, and
Yeah,
sprints through the airport. Is he like doing that too?
yes, he does. I've seen it. He's in great shape because he can make those runs.
I'm at the airport 3 hours in advance. I don't care. I'll sit and be bored, but I'm not going through that stress.
You know, we started going more through Burbank Airport
Uh-huh.
because from the time you hit outside of the airport to your gate could be 15 minutes. It's
Wow.
just, I know everyone's going to listen and be like, well, screw you, Rick. Now I'm taking Burbank Airport. And I'll be
Uh-huh.
like, whatever. But in our household, we have decided if the tickets are about $100 more, that's kind of like our dollar limit.
Mhm.
Because there's two of us, so 200 bucks. Right now, our daughter's free. So
Yeah.
it's like, we're willing to pay for that premium to not have to go to LAX, which could take an hour with traffic.
Mhm.
Then, even with TSA pre-check, go through it. It could be a hassle. It's just,
Yeah.
yeah. So domestically, we do
That's
Burbank.
really, really cool. When I lived in OC, we used to go to Ontario Airport all the time.
Right.
And then now Ontario Airport's, massive,
I
but
know.
it was the same thing. And then we'd also fly John Wayne. And as same as you, I had $100. I'll pay $100 to fly out of John Wayne, but no more. But when I did fly out of John Wayne, it was like, this is so easy.
Yeah. I remember my dad, he hated to fly, just was not his thing. And then I said, Dad, just fly down here. Just come through Burbank. He came through Burbank. He's like, oh my gosh, I'm never going to LAX again. He's like, I'll come down and see you. That's fine. Like it was just not a big deal from the Bay Area. So you're going from like Oakland Airport, small airport to small airport, and it's like, yeah, you just walk on the tarmac, come off, and you're done.
I,
So
I love it. I will, I've never flown into Burbank before. I've always flown, I live in Colorado. I've been flying into Ontario or John Wayne, or most of the time it's LAX because it's just easy. And I always
sure,
think, I'm never doing this again. And then I'm never doing this, and I just keep doing it again. But
yeah,
I'm gonna try.
it's toxic, right? Like it's very toxic. So I
Oh,
want to switching gears a little bit from because I think we've talked a lot about the cost segregation. What are your, especially here in Southern California, what are you seeing investors do with from a tax perspective outside of the cost segregation? Because there's always so much more to it.
yeah, and there's really not much to do. That's
Interesting.
the thing. There's cost segregation, and then when you start putting money into it, there's a lot of opportunity. But besides that, I mean, the franchise tax board is tough.
Hmm.
The property taxes are what they are, and they don't accept, bonus depreciation on acceleration. There's nothing you can do about that. I'd rather deal with the IRS than the franchise tax board personally.
Hmm.
But there's really not that much to do. And
Hmm.
now there's kind of loophole. I hate that word loophole, but like if you buy an Airbnb in California
Hmm.
and you are not a real estate professional, meaning you don't make a living, managing your real estate, you can still take all that additional depreciation from that if it's an Airbnb and offset your income or your spouse's income with it, because a short-term rental is like a hotel. It's not
Right.
like a rental property. So you don't have to be a real estate professional to take all that additional depreciation that we create and offset your income with it. You just have to have an Airbnb. The average stay is 7 days or less during the year. And then if we say it's $1 million, we create 100,000 in additional depreciation. Take that depreciation and offset your ordinary income, because you own a business, not a rental property. Um,
Mm,
and that's kind of complicated. But besides that, there's really not a lot to do. So it's so important to take advantage of what is available. Certainly cost segregation if you got the income for it, and certainly utilize these regulations when you start putting money into a property, which you're going to have to do eventually, because they will allow you to expense it, or a lot of cases expense it. And if you can't expense it, you can expense what was thrown away. So you have to take advantage of what's there, because there's not 50 things, 50 opportunities, Rick. There's maybe a handful. You have to take advantage of those. Otherwise, you're going to get crucified in taxes. And you and I talked about this before. I was on. I lived in OC for a while. I think California is the most beautiful state in the country. I love it, but it's not free. Everybody wants to live there because it's so awesome, and
right.
raises your prices up, which is fine. If you make the choice, if you embrace everything that LA and California has, it's a bargain, in my opinion, because the
Hmm.
quality of life is so amazing. But you have to get your taxes down to a manageable level to be able to afford to live in LA, and that's what we both want for your listeners. And
It's interesting. I had a client a few years ago. She was house hacking. So I was helping her buy a house where the back unit was actually done without permits. We were going to get it permitted. And she's like, I don't know if I can afford the house. And so we're like, look, we can't give tax advice, but have you talked to your CPA about all the tax benefits of owning your home? Plus, you are receiving income, like legitimate income. She's like, oh, I should do that. And it came out to like, she could adjust her tax withholdings by like $600 a month.
Mhm.
And she's like, "Oh, yeah, I can afford this."
Wow.
I mean, you know what I mean? Because it's like there's all these benefits. Now, a question that I might have is you do have these high net worth people. They have cash. How often have you seen people buy properties specifically for the tax benefits? They're like, I don't really care about the cash flow. I don't really care. I need the tax break because I'm just getting reamed.
Yeah, and if and I have seen that. And it's another good question. So there are certain properties where, like a car wash or a
Hmm.
gas station or a convenience store, where you don't have that long depreciation time. It's not 39 years. You can actually take a gas station, a car wash, or a convenience store, as long as the convenience store and the gas station have at least 50% of their revenue is from gas. And you can
Hmm.
depreciate those over 15 years. And with bonus depreciation, which we haven't talked about, but that's another podcast, you can take, well, back in 2020, you could take all of it, 100% of it, and take it in that current year. Now it's kind of this sunsetted a little bit, where if you buy a property in 24, you can take 40% of that purchase price and put all the depreciation at 40% of it, of the total, into the current year. So there's,
Hmm.
if your clients are looking for strictly just something to bail me out of this ridiculous
Right.
situation I'm in, look at car washes and gas stations. They're for
Interesting.
sale. They're everywhere in the United States. You could find 100. I could find 100 of them for sale right now. But
Sure.
put your money in that, because the depreciation's different. It's more advantageous than buying a rental property, which is slightly more advantageous than buying like a warehouse. But
Hmm.
look at properties like that, because that will really save you taxes.
Interesting. Because you're also because you're basically you're buying the business as well as potentially the land.
Exactly, and sometimes you'll buy the land, and Circle K or whatever will do a land lease. They'll lease it from you.
Oh, I
Uh,
love ground leases.
I do
It's
too.
it's like a deal with the devil and you're the devil, and it's like, yeah, dude.
I know.
Yeah.
I know. Well, I wish I knew about him, 20 years
Oh
ago.
yeah.
But
Well,
nonetheless, yeah, that's what I would do. If somebody said, "Hey, Kevin, man, I got a $5 million tax bill, help." I said, "Go buy a gas station. Just go buy it." Well, I don't know anything about gas stations. Who cares? You don't have to. You know,
if in management, you have
Circle K
whatever.
is going to run it. You don't have to. Just buy it.
Interesting. Now, on the like property side, have you noticed a difference in we'll call it tax benefits or tax strategies of like 1 to 4 units versus like the commercial with office buildings versus 100 unit apartment building, right? Because these are all different, I call them asset classes, right? Because they're different categories.
Uh-huh.
Have you noticed any big differences? Is the government's like, no, we love housing people, so we're going to give more benefits to that?
The benefits are pretty much across the board because the
Okay,
depreciation laws cover all assets. You know,
got it.
However, a residential rental property, you're going to, let's say you don't do a cost segregation, you just do straight line. Well, that's going to be the purchase price divided by 27 and a half. Or if you buy
Hmm.
a commercial property, a warehouse, a strip center, whatever, now you're going to depreciate that over 30
Yeah.
years. So the depreciation benefit is much better on a residential rental property than it is a commercial property. But the laws
Mhm.
change. The laws are the law. Mhm.
And then it makes sense to do things like the cost segregation on those malls and warehouses because you're at a much bigger price point because it's depreciated over 39 years.
Yeah, yeah. The tax benefit is actually much greater from
Right.
on cost segregation from a
Yeah.
commercial property. Mhm.
Got it.
Yeah.
So then my last question, on more on the big side, the commercial buildings, all that is, we've seen like a mini crash in that world, and then they're saying there might be another one. And a lot of that has to do with just refinancing, right? Because you can't, in residential, you hold on to a loan for 30 years. At the bigger people, it's every 5 years. Basically, there's like a balloon payment. So has there been a correlation with what's going on in that world to the tax side? Are people getting more aggressive on their taxes because they're like, well, we couldn't raise rents high enough to keep up with that. Now my interest rates doubled.
Yeah, yeah. There has been a mini crash. You're absolutely
Yeah.
correct, and I really expected interest rates to be down by now.
Yeah.
I've refinanced. I mean, I bought that rental property in Colorado. I think I put 10% down, and I said, "Oh, okay." I'm paying. I don't know what it was. It was over six, and but
Mhm.
that'll drop to 4 and 5. Within a year. It's an election year. It never did, and now we have a Republican administration. Still hasn't dropped. It is extremely difficult now to buy a property, whether it's commercial or whether it's residential, and finance it. And they pay cash, that's different, but and finance it and make it work. I don't
Yeah.
know. I don't know how investors are doing it when you can't raise rents either. So what do? So you have a big fixed costs, and maybe your rents will cash flow it, maybe.
Yeah.
What about all the repairs I have to do and all that? And so what people are doing is they're pulling back on doing the repairs. They're letting the property go until they can't put
Mm,
buckets on. You got rain coming through. It's the tenants say, I got a leaky roof. Well, here's a bucket. Put the bucket over there. Where it's leaking.
yeah.
After 4 or 5 buckets, you can't do anything anymore. That's what I'm seeing, and that's a concern of mine. You know,
Yeah.
interest rates are not going down. Nobody's going to refinance.
Right.
What's the point? And then they're not going to be able to raise cash. They're not going to be able to drop their payments, and they're going to stop buying. You know,
Hmm.
that's kind of what I've been seeing is
Yeah.
the purchases have been getting less and less.
Yeah. I mean, I'm seeing a lot of vacancies, you
Mm.
know, like even on Ventura and Sepulveda.
Uh-huh.
There's the Galleria right there. There
Yeah.
was like
Yeah.
Urban Home that was on that corner. It's like furniture. They've been gone forever, and they
So
just
there's
can't.
vacancies at the gallery. I've been in a
Yeah,
gallery. Look,
yeah,
wow.
yeah. And I've heard different reasons. I've heard part of it is because of the way it's designed. It's almost like a U shape. So when you have stores on the inside, how do they get street exposure?
Mhm.
So
Yeah.
some people are looking like, I would love to rent it, but I'm already missing out on the, we'll call it free marketing, right? That's why people rent on Rodeo Drive and pay the $200,000 a year or a month. They may not be making that, but they know that if a celebrity's walking by and someone's taking a photo, well, now there's Louis Vuitton in the background. They just got free marketing, right? It's just it's a
Interesting.
business expense.
Yeah, interesting. Yeah,
Uh,
and the funny thing, I mean, 10 years ago, nobody cared about the U-shaped. You know, there,
yeah,
there there was no vacancies there. Where
yeah.
now people are a little more, a little bit more discerning. Okay, I don't think this maybe is so good. Personally, I don't see how you can go wrong with the Galleria. But, I'm not a real estate guy, but that's amazing because 10 years ago that was not the case.
Yeah. It also could be that they're just asking for so much money. Because for single family homes, it's like, okay, what do the house next door sell for? In the
Right.
commercial space, it's like, well, what are my rents?
Yeah.
So I can't drop my rents because that devalues my building. And how am I supposed to refinance? Like
Yeah.
it's vicious. I
It
knew someone
is.
who owned industrial warehouses. So I started picking his brain.
Uh,
He bought like a portfolio of them in like 2000. And he's had the same tenants for over 20 some years because he's like, if you have a vacancy, it could take years to fill it.
wow.
So it's like you're better off working with who you have
Uh,
and all of that. And him and his business partners paid all cash. So like the interest rates never was an issue for them. But it was just interesting to see how all this stuff is correlating. It's like, yeah, you can do all these tax write-offs, but is it going to be enough to offset some of these major headaches that are coming our way? And some of these buildings are selling at a loss, is what I've been
yeah.
reading.
Yeah, no, that's interesting. Yeah, I guess if you do own like a manufacturing facility and you've made all these, the tenants made improvements, or you've made the,
Yeah.
I mean, you have this manufacturing facility set up, and that manufacturer goes away. Where do you find another one?
Right. And it
Yeah,
works both ways. If you're a tenant, you're like, I don't want to leave.
true.
And
Yeah.
if you're the landlord, like, I don't want you to leave, but everyone wants to make money here. So what do we do?
And,
Right?
that's an you made me think of something. So let's say you own a warehouse and your
Hmm.
tenant does all the tenant improvements. They spend
Oh yeah. Shit, that's a good
$100,000.
question. Go for it.
Yeah, the tenant can also cost segregate, even though they don't own the building. They have paid for all those tenant improvements.
Hmm.
They can cost segregate and they can take advantage of in the TCJA, it's called a QIP, a qualified improvement property, which means
Hmm.
if you don't impact the elevators, escalators, or anything structural within that tenant space, you
Hmm.
appreciate everything you spend over 15 years and take bonus on it. And
Uh,
then you could cost segregate and put some of it into a 5-year category. I get that a lot. A lot of tenants miss this. They think they have to own a building to segregate. Doctors, dentists, anybody who's putting
mm,
money into their practice, but they don't own the building. They're just a tenant.
right.
Phenomenal opportunities
But
for you and I to
it's
help.
a business expense. Why wouldn't it be? It's just like any other business expense. I have to buy desks. I have to buy all this office supplies. Well, I had to make improvements to make my business function.
Yeah, yeah, but it's a lot of CPAs will depreciate those tenant improvements over a longer life than is necessary.
Mm. So if I'm an owner of a commercial building, I mean, I think I already know the answer, but I'm going to ask it anyways. Is there any benefit to the owner doing those tenant improvements before the tenant moves in versus the tenant doing it?
Yeah, there is tenant and let's see, and lessor taxes are
Hmm.
extremely complicated. But yeah, there is because if you're the owner, you do those TIs, you get to depreciate them. You get to expense all the crap that you threw out
Right.
during those TIs, and you own them when the tenant moves out. They're
Right.
they're not the tenants. There's no going back and forth and changing how a lease is written because the tenant wants to own them, and the landlord wants to own it. You do it yourself. You own it. They're yours. You have all the tax benefits of cost segregation, those repair regulations, removal costs, pads, all that is yours.
So I wonder if going forward, if more property owners do that because of the interest rates are higher, they go, hey, well, let's infuse more cash into this to get the tax benefits to offset some of this. And there's value to having that equipment. So if that tenant leaves, like if
Yeah.
it's a restaurant, someone else can come in and say, look, the equipment's already there.
Yeah, and then I love that. I love that idea. And if they're not doing it, they should. And if they're not doing it, because it's because they don't understand the very basics of how tenant and landlord taxes work.
Yeah.
Be able to raise their hand and say, well, what if we did it this way? What if we did it that way? And so I just implore your listeners, don't go along with what somebody's telling you have to do for taxes, whether it's a CPA, whether it's a tax attorney, get a second opinion, reach out to Rick. Rick, this is our situation. What do you think?
Hmm.
Brain surgery, get a second opinion,
Yeah.
before somebody's has a scalpel, so you know what's going to happen. But if they're not doing that, Rick, they absolutely should.
Yeah. That's interesting. And now I have to like, okay, well, you look at some of these places. I'm curious to see what percentage of these properties does the tenant do the improvements versus the landlord. Okay, another time. All
Yeah,
right, so right, Kevin, thank you so much for being on. This has been phenomenal.
definitely.
I really appreciate it. How can people get a hold of you?
Oh, they can get looking me up on my website. My name is Kevin Jerry. My last name is Jerry. It's a long story. Long. My grandfather got kicked out of the Dutch army during a war. He got kicked out. That's what a quality guy he was. He snuck into Canada, changed his name to Jerry now. So it's my name is Kevin Jerry, and the name of my company is Kevin A. Jerry MST. I have a master's degree in taxation.com.
Awesome.
KAMST.com. Take a look, you'll get all the information that you need.
Perfect. Well, thank you so much again for being on. Thank you for everyone for listening, and I will talk to you soon. Thanks for tuning in to The Key to the City of Angels. I hope you found today's episode helpful as you navigate the world of Los Angeles real estate. Whether you're looking to buy your first home, expand your investment portfolio, or sell in this competitive market, I'm here to help you succeed. Let's connect. Visit my website or follow me on social media to learn more about how I can help you achieve your real estate goals. And if you're ready to take the next step, don't hesitate to reach out. I'd love to work with you. If you've enjoyed this episode, be sure to subscribe, leave a review, and share it with someone who might benefit. Together, let's unlock your potential and make your real estate dreams a reality.